March 9, 2023, 9 a.m. Silicon Valley Bank has $209 billion in assets. It's the 16th largest bank in America, the go-to bank for half of all U.S. venture-backed tech companies. By 11 a.m., customers attempt to withdraw $42 billion. That's 1/4 of all deposits in 2 hours. By 5 p.m., the bank is insolvent. By the next morning, California regulators shut it down. The FDIC takes control. 36 hours, from healthy to dead. 2 days later, Signature Bank collapses, then First Republic. The Federal Reserve announces an emergency $300 billion backstop to prevent total system meltdown. This wasn't a traditional bank run with lines around the block. This was the first Twitter-fueled bank run in history. And what killed these banks reveals a structural flaw that still exists in hundreds of banks right now. FDIC's own data, $500 billion in unrealized losses still sitting on U.S. bank balance sheets as of mid-2025. This is the autopsy of what really happened and why it's not over. Here's what nobody explains clearly. Silicon Valley Bank didn't fail because of bad loans or fraud. It failed because of what happened to U.S. Treasury bonds when interest rates rose. 2020 to 2021, the Federal Reserve holds rates at zero. Tech boom explodes. Venture capital floods into startups. And all those startups bank at SVB. Deposits surge. In 2020, SVB has $103 billion in deposits. By 2021, $191 billion. That's 85% growth in 1 year. SVB has a massive problem. What do you do with $88 billion in new deposits when nobody wants loans because startups are flush with VC cash? Their solution? Buy safe U.S. Treasury bonds and mortgage-backed securities. They invest heavily in long-term bonds yielding 1.5 to 2.5%. Safe, government-backed, perfect if interest rates stay low forever. The fatal assumption. The Fed will keep rates near zero for years. March 2022, inflation hits 8.5%. The Federal Reserve panics. They raise interest rates faster than they have in 40 years. From March 2022 to March 2023, rates move from 0.25% to 4.75%, the fastest increase since Paul Volcker in the 1980s. Here's the mathematical death sentence. When interest rates rise, bond prices fall. This is not opinion. This is arithmetic. If you bought a 10-year Treasury in 2021 yielding 1.5% and rates rise to 5%, your bond is now worth roughly 30% less. Nobody wants a 1.5% bond when new bonds pay 5%. SVB's situation by early 2023. They hold $120 billion in long-term bonds purchased at yields of 1.5 to 2.5%. Current market rates, 4 to 5%. Unrealized losses, over $15 billion. SVB uses held-to-maturity accounting. If you classify bonds as HTM, you don't have to report unrealized losses on your balance sheet. The logic: we're holding these to maturity, so the temporary price drop doesn't matter. This works perfectly unless depositors want their money back. Then you're forced to sell at a loss. By February 2023, SVB has masked around $15 billion in losses using HTM accounting. The bonds aren't worthless, but they're worth far less than SVB paid. As long as deposits stay in the bank, no problem. But deposits aren't staying. March 8, 2023. SVB management tries to get ahead of the problem. They announce 3 things. 1, they're selling $21 billion in securities. 2, they're realizing a $1.8 billion loss. 3, they're raising $2.25 billion in new capital. Meant to look proactive. Instead, it sends a message: SVB is in trouble. By morning of March 9th, venture capitalists are in group chats and on Twitter telling their companies to withdraw funds immediately. Founders Fund tells companies to pull money. Coatue says withdraw. The message spreads in minutes. This isn't 1929. This is 2023. Every startup can wire its entire balance from a phone. By end of day March 9th, 42 billion in withdrawal requests. 25% of deposits in one day. To meet withdrawals, SVB sells bonds at massive losses. The hole grows. Panic accelerates. Death spiral. The concentration problem. 89% of SVB's deposits were uninsured, above the 250,000 FDIC limit. Typical banks, 30 to 40%. Worse, over 90% of deposits came from venture-backed tech companies. They all talk to each other. They all follow the same VCs. Panic spreads instantly. By 5 p.m., March 9th, SVB is insolvent. March 10th, 6 a.m. California regulators close SVB. FDIC takes control. Total time, 36 hours. March 12th, Signature Bank collapses. Signature held $110 billion in assets, heavily involved in crypto. After SVB fell, depositors fear contagion. Signature faces $10 billion in withdrawal requests in one weekend. Regulators close it Sunday night. First Republic, with $212 billion in assets, caters to wealthy clients. Different business model. Doesn't matter. Association equals death. Stock drops 90%. $100 billion in deposits flee. Major banks provide $30 billion in rescue funds. Still fails 6 weeks later. May 1st, 2023. JP Morgan acquires First Republic. Cost to FDIC, $13 billion. Sunday, March 12th, 2023. Emergency meeting at the Treasury. Yellen, Powell, FDIC, White House advisors. The realization? If they don't act, every regional bank could face a run on Monday. The $7 trillion sector could collapse in days. Decision? Invoke the systemic risk exception. Guarantee all deposits at SVB and Signature, even above $250,000. The Fed also announces the Bank Term Funding Program, $300 billion available so banks won't have to sell bonds at losses. Message? We will not let the banking system collapse. Panic stops, markets stabilize. Mid-2025. U.S. banks still hold about $500 billion in unrealized losses. Down from the 2023 peak, but still massive. Meaning, hundreds of banks hold bonds worth less than they paid. Manageable if depositors stay calm. Dangerous if they don't. 1930s bank run, visible, slow. 2023 bank run, silent, digital. 42 billion withdrawn in one day using phones. Modern bank runs move faster than regulators expected. SVB also operated without a chief risk officer for 8 months in 2022, the exact period when the Fed was raising rates rapidly. A 2021 Fed review flagged risk management problems. They weren't fixed. SVB was under special review by late 2022. Regulators saw the issues, they just didn't act forcefully enough. Feb 27, 2023, 10 days before collapse, SVB CEO sells $3.6 million in stock. March 10th, hours before seizure, employees get bonuses. This feels suspicious. Insiders knew. In 2018, SVB pushed for the deregulation law that raised the threshold for strict Fed oversight from $50 billion to $250 billion. After the law, SVB avoided tougher stress tests. The Fed's 2023 review concluded this regulatory rollback contributed to failure. Banks most at risk in 2025 share traits: high unrealized losses, high uninsured deposits, Concentrated customers. Rapid deposit growth in 2020-2021. Exposure to commercial real estate. How to check your bank's safety? Step 1. Go to FDIC Bank Find Suite. Step 2. Search your bank. Step 3. Look for 3 items: unrealized losses, uninsured deposit percentage, and the Texas ratio. Uninsured deposits under 40%, normal. 40 to 60, elevated risk. Over 60, high risk. SVB was 89%. Texas ratio. Under 50%, healthy. 50 to 100, concerning. Over 100, dangerous. What you should do: diversify if you exceed FDIC limits, $250K per depositor, per bank, per account type. Joint accounts get $500K. Consider alternatives: Treasury Direct, money market funds, brokered CDs. Watch for warning signs: unusual promotional rates, executive departures, stock price weakness, regulatory reviews. March 27, 2023. First Citizens acquires most of SVB. The bank survives, but the structural problems remain. As of late 2025, $500 billion in unrealized losses still sit on bank balance sheets. Rates remain elevated. Commercial real estate stress rising. The Fed's BTFP program expired in 2024. There is no backstop. The lesson: modern bank runs happen in hours. Unrealized losses become realized instantly. Concentration risk turns manageable issues into existential crises. The 2023 banking crisis didn't end, it paused. The next trigger could be commercial real estate defaults, a recession, forced bond sales, or something we don't see yet. Check your bank tonight. FDIC data takes 5 minutes. If your bank has high losses and high uninsured deposits, you still have time to diversify. In 2023, people who waited lost access to funds for days or weeks. Those who acted early were fine. Should I cover the coming commercial real estate crisis next? 70% of CRE loans sit inside the same fragile regional banks. Tell me in the comments.